Hey everyone, welcome back to my channel. I am Sonia, your personal finance educator, and I am here to help you take control of your finances. On this channel, we dive into budgeting, saving, and investing, all things personal finance. Whether you're just starting out or looking to level up your finance knowledge, you'll find practical tips and tools to make managing money easier. Let's get financially inspired and start building a stronger, more secure future together. Let's get started with the video. We're going to be doing a 3K investment challenge. Yeah. I'm super excited. I'm kicking off this 3K investment challenge. The goal is to build the habit of saving and growing my money by investing in stocks. Now, the purpose of this challenge is simple. We know that keeping money in a traditional savings account doesn't really help it grow. I've mentioned this on my channel before that I want to help people at all levels when it comes to finance. If you're new to investing, I always recommend starting with a high yield savings account. If you don't know what a high yield savings account, I will have the link to the video I did explaining what that is. It's a great way to let your money grow a bit while it sits. And once you have that set up, especially after saving at least $1,000 in your emergency fund, it might be time to consider investing. Now, I'm not saying you have to invest in exactly what I'm choosing, but through this challenge, I'll show you the steps I'm taking and update you on the account's progress along the way. Before we dive in, I want to give you a quick disclaimer. I am not a financial advisor, and this video is for informational and entertainment purpose only. Everything I'm sharing is based on my own experience and my personal journey, so please don't take this as financial advice. Make sure you do your own research, and if needed, consult with a qualified financial advisor before making any financial decisions. The first thing we're going to learn about is index funds. We're going to watch a quick video on YouTube. So on the screen, I'm going to have a quick video play about explaining ETFs. The video is actually by Charles Schwab.
An exchange-traded fund, or ETF, is an investment fund that trades like a stock. ETFs, like other types of funds, pool together money from investors into a basket of different investments, including stocks, bonds, and other securities. By spreading the fund's money into different securities, ETFs can generally provide investors with diversification, which can help manage risk. And because ETF shares are traded on a stock exchange, they're bought and sold like stocks and may incur commissions. It's also worth noting that an ETF's market price may differ from the total combined value of its holdings, known as its net asset value, or NAV. These discrepancies are due to the way ETFs trade and track the value of their component investments and are typically minor. Just like there are a variety of mutual funds, there are a variety of ETFs, each with its own stated objective. Some ETFs invest in stocks, others may invest in bonds or other assets. Some may seek to replicate the performance of a broad market index like the Dow Jones Industrial Average or S&P 500. Other ETFs may track the performance of a particular sector or industry like information technology or pharmaceuticals. The level of diversification an ETF provides depends on the index it tracks. For example, ETFs that track a specific stock sector would offer less diversification than one designed to replicate a broad market index. Let's look at an example of investing in an ETF. Suppose an investor wants to make a diversified investment that is designed to mirror the performance of a major stock index like the S&P 500. After researching different ETFs and finding one that meets their objective, they purchase shares of it just like they would an individual stock. Now that they own shares, the investor has exposure to each of the fund's basket of investments while only having to purchase one ETF. This can save an investor research and analysis time. So how can investors potentially profit from an ETF? Similar to a stock, they can earn a return two ways: a rising underlying asset price and dividends. Typically, if the value of the ETF's investments increases, so does its price. If an investor purchased a hypothetical ETF at $40, and a year later it was selling for $50, the investor could profit $10 per share by selling the position. Of course, if the ETF's price dropped, the investor would have lost money if the position was sold at the lower price. Because most ETFs are traded on a stock exchange, they can be bought and sold throughout the day. However, not all ETFs are widely traded. which can cause difficulty when trying to fill orders.
If you want to have the link to the video, I will have it in my description if you want to go back and watch it again. I hope you were able to get a better understanding of ETFs. So, as you can see on this page, we are actually going to be looking at 3 index funds: VOO, which is right here, QQQ, and VTI. So let's take a quick look at Vanguard S&P 500 ETF, also known as VOO. This ETF is a type of index fund that tracks the S&P 500, meaning it includes the top 500 companies in the United States by market cap. First, we can see that the current market price for one of the shares of VOO is $522.67. Now, by the time you see this video, these numbers are definitely going to be different as far as the market price, because as you know, with the stock market, it changes daily. So I believe when I did this, I was creating this PowerPoint. This was probably like on October 31st or November 1st. So this is the number that I got. Market price basically means if you wanted to buy a single share of this, it would cost the $522.67. We have the year to date, which is the YTD returns, which is sitting at 23%. This means that if you had invested in this fund at the beginning of the year, your investment would have grown 23%. Keep in mind that returns fluctuate. They aren't guaranteed. Now let's go over the top 10 holdings in VOO. These are the biggest companies in the fund, making up a large portion of the total investment. Here's a quick breakdown. As you can see, we have Apple at basically 7%, Microsoft at basically 7%, Nvidia, Amazon, Facebook. These companies are considered the most stable and high-performing businesses in the market, which is part of what makes VOO popular choice of long-term investors. Because it's diversified across many companies, it helps reduce risk and allowing potential growth over time. That's a quick look at VOO. Now, let's go on to the next one. So now we're going to be looking at VTI, which is Vanguard Total Stock Market Index Fund. This fund is designed to give you exposure to the U.S. stock market, including large, medium, and small cap companies. So by investing in VTI, you're investing across the entire spectrum of the U.S. market. So the price per share of VTI is $281.03. That's how much you would pay, like I said again, for a single share, for owning a single share of this. The year-to-date returns for VTI is 22%. Like I said, with VOO, it's the same with VTI. If you were to invest in this company at the beginning of the year or the beginning of last year, you would be up 22% off your original investment. While VTI covers thousands of companies, a large part of its holdings is still focused on some of the biggest names in the market. So here's a quick look of the top 10 holdings with VTI. Good choice for those who want a single investment that spreads across the entire U.S. stock market. It's diversified across various sectors and the company's sizes, so it's generally less volatile than funds focused on specific industries. It's a great option if you're looking to get into a broad exposure in one go. Now we're going to go to QQQ. So QQQ is another index fund. QQQ tracks the NASDAQ 100 index, which includes 100 of the largest non-financial companies listed on NASDAQ stock exchange. This makes QQQ heavily focused on technology and other high-growth industries. The current market price for QQQ is $483.85. So like I said before, if you wanted to buy a full single share of this ETF, you would have to pay the $483. The year-to-date returns for QQQ is 22%. This strong performance reflects the high growth of tech stocks in the NASDAQ 100. However, because it is tech-heavy focus, QQQ can be more volatile than like VOO, because in VOO they have all 11 sectors. That's something to look at too when it comes to QQQ. If you look at the top 10 holdings, these companies make up a large portion of QQQ. Because of this, QQQ can be impressive growth during tech booms. So if you notice, look at the percentages as far as Apple. Like when we were looking at VOO, they only had like 6%, but with QQQ, they're almost at 9%. The same with Microsoft and Nvidia. So I want you guys to take a quick guess of what ETF do you think that I'm going to be choosing to do this challenge with. I want to give you guys a few seconds to take a guess. Please do not cheat and skip ahead. I'm watching you. All right, so let me give you guys a drum roll. Oh, did you guess yet? Did you guess? Let me give you another drum roll. We're going with VOO, people. Yeah. So that is actually the ETF that we're going to be invested in with the start of this challenge. I'm super excited. I had my own personal reasons for choosing VOO. I will go into that later on in this video. The method that I am going to be using to do this challenge is dollar cost averaging. I know you're like, what is dollar cost averaging? For those who don't know what dollar cost averaging is, it's the practice of investing a fixed dollar amount on a regular basis regardless of the share price. So in this chart here, you can see that each time the price moves, there's a buy marker. So this is showing that regardless of the price is going up or down, you're consistently investing the same amount. When the prices are high, your money buys fewer shares. When the prices are low, your money buys more shares. I know you're like, why use dollar cost average? The beauty of this strategy is that it reduces the impact of market volatility. Instead of trying to time the market, you're spreading your investments over time. Over a long term, this can lead to lower average cost per share, which may increase your gains as price rises. And I'm going to have an example of that. The benefits of dollar cost averaging. 1. It reduces the risk by not investing all your money at once. Dollar cost averaging reduces the risk of buying at a high point in the market. Number 2, it's a set and forget approach that builds a habit of regular investing, making it easier to grow wealth over time without the stress of timing the market. Now, I'm not going to lie, when I started my investment journey, I was always like timing the market. Like this is going to be actually my first time I start dollar cost averaging. I'm excited. I'm excited to try it because like I said before, I would always time the market or I would catch stock splits. So like when Apple split, I caught it. When Amazon split, I caught it. When Tesla split, I caught it. I would always catch stock splits or time the market. So this is an example of what dollar cost averaging would look like. So I'm going to go and explain this. So basically, if you were dollar cost averaging, let's say for the next 5 months, right? And every month you're putting $100 in your investment, but the stock that you are purchasing is $5 per share. With month 1, investing $100 in a stock that's $5 per share will get you 20 shares of that company. And it goes on for the next month. The same with month 3. You're investing $100. Let's just say the stock goes down from $5, which is its high, down to $2, which is its low. It's the lowest the stock has ever been. It's at $2. You still put that same $100 in, but now the stock costs $2 per share. You're getting 50 shares instead of 20 shares at its high. And you continue that down the line. Look, month 4, you invest $100. The stock is now at $4, where it's like it's not too high, not too low. It's just like right in the middle. And with that, you're getting 25 shares. So let's just say you decided to invest $100 each month for the next 5 months. That's $500 invested. Now, with you doing dollar cost averaging, instead of you getting it at its high at $5, buying it at different points of time within the next 5 months brings your average cost per share to $3.70. And now you have 135 shares of that company. So let's take a look at what it would look like without dollar cost averaging. So this is what it would look like with dollar cost averaging. Instead of doing it by month to month, you decide to invest a lump sum of that $500 in month 1, at its high, at the stock's high, which is $5, that only gets you 100 shares. So when you go back to look at your account, your original investment of $500 got that company at a price point at $5, and you only own 100 shares of that company. So now I'm going to show you like the difference in gains over time. This is what your account would look like if you did dollar cost averaging with an original investment of $500. So we're still using that $500, but with this $500, you were able to put $100 every single month for 5 months. So you only put $500 into this specific company. So with that being said, with you doing that month to month, you change the cost per share to the $3.70 because you weren't getting it at its high and you weren't getting it at its low every single month. So now it kind of brought your average down. So with that being said, with you doing that on a month-to-month basis, you now own a total of 135 shares. So let's just say that stock goes up to $8. With the stock going up to $8, it makes your gains per share higher. So with your original investment, technically you with your original investment, you got all those shares, those 135 shares at a price of $3.70. So when it goes up to $8, you've earned $4.30 per share. So this is what your entire portfolio would look like. You would have turned $500 to $1,080 in 5 months by dollar cost averaging. So that gives you $580 in gains. I hope that was easy to understand. If it wasn't and you have questions, please comment down below. So this is what it would look like without. Let's just say you did your original $500 investment for that first month. You got the stock at its high, $5, correct? And the share goes up. It meets a new high, which is $8. So you took your $500, you only invested for that first month, and you bought, it was $5 per share, and you only got 100 shares. So with the stock going up to $8, your new gains is only $800. So your portfolio is only worth $800. So it only went up $3 per share instead of $4.30 per share with dollar cost averaging. So you only gained $300, which is still good. Don't get me wrong, which is still good. You want to capitalize on those gains as much as you can. So now we're going to go into my current account. So I'm going to do a little story time on this account. I think it's so funny, bro. With this particular account, I don't know if I told you, but I usually invest with Charles Schwab. But I do have another investment account with Vanguard, but I would never use it. And I like keeping my accounts separate. So I like keeping my individual stocks separate from my ETFs. So with that being said, I learned that Vanguard, if you invest in Vanguard ETFs, you can do fractional shares. If you don't know what fractional shares are, basically instead of putting, let's just say VOO is $500 and something dollars. Let's just say I don't have $500 to invest one time into VOO. So with fractional shares, you can put in what you have. So let's just say I only have $5 or $10 or $15. I can put that in little by little to eventually own a full share of VOO. So that's what I wanted to do with this account. But with me not always investing with this account, I totally forgot about it. The goal was to put maybe like $10 like every month. Like this was a year ago, so I don't even think I had a full-time job at this time. I think I only had part-time, and I was getting week-to-week checks. Like y'all was there in the beginning when I was only getting like $300 a week. So basically that's what that was. That's what this account was for, but I totally forgot about it. And even though I only owned fractional shares of these 5 ETFs. As you can see, it says it right here. So I had put $50 in this account, and I was like, okay, so I did my research on these 5 ETFs, and I was like, okay, so these are the ETFs I'm going to start investing in, and I'm going to be putting money in them little by little. So for a full share at the time of August for this ETF was $282. The same with this one. This one was $428 back in 2023. This one was $221 back in 2023. This one was $248 back in 2023, and this one was $409 back in 2023. So I invested basically $10 in all of these, and then I forgot about it for a year. With me forgetting about it, my account still grew. So my account still went, like I said, the original investment was only $50, and my account went up $16. With me just owning $10 of these shares for a year. $10 of these companies, which is not even a full share. Like, as you can see, it says 0.02. But these are actually the current prices of how much these stocks are worth today. You look at the original stock price a year ago, it was worth $428. Today it's worth $600. Okay. The same, look at VOO. VOO was $409 a year ago. Look at VOO today, $533. All these stocks went up. VUG, $282 a year ago, $394 today. So imagine if I kept investing in these companies little by little and I didn't forget about the account. That brings us to today. We're gonna be starting today. All right, so this is what my goal for this account to look like. This is actually a compound interest like calculator. So I put the $3,000 as the initial investment because that is the goal for this account. Get this account to $3,000 and let it sit. So with that being said, if I put $3,000 in VOO and their annual return is 23%, by 2029, my account should be at $9,000. Obviously, within the next 5 years, I'm going to still continue to invest in this account, but this is just to show you what it would look like if I just put $3,000 and left it for 5 years. You see, my account went up, what? How much percent? 26% from a year ago. So imagine in 5 years. That leaves us to now. We're actually going to be investing starting today. So I've already actually invested $65 out of my recent paycheck to put into this account. As you can see, it's going to be right here. This is showing it being executed. I bought VOO. The status is executed. I bought it on November 1st. This is my brokerage account. I covered up my account number. The symbol is VOO. This is the holdings name. And I put $65.92 in it at the price of $527. So, yeah. So we're actually going to color this in because this is the amount that we put in. So, but this is the chart that I'm going to be using. It's estimated at like 5 shares of VOO because as you can see, like VOO is at $500 and something. And if it continues to go up, then, you know, it is what it is. But I just want to put $3,000 in there. So we're actually going to color this in real quick. So let's go ahead and color this in. Bam. 1 square complete. Alright, so 1 square complete and many more to go. Alright, so that is actually going to be the end of this video. I hope you guys enjoyed. Please make sure you like, comment, and subscribe. And if you plan on doing this challenge with me, let me know. Or if you just want to see how it goes, let me know that too. If you do have any questions about ETFs or investing or, you know, anything like that, please feel free to comment. I will try to answer your questions with the best of my ability. And Yeah, that's it. I'm super excited to start this challenge. We're still doing my 1K savings challenge. You will get an updated video on that. But yeah, guys, that's it for this video. Bye, y'all.
She really want more. Hey, girl, what you did it to fi put in on me phone. Me back in a minute, cause me really miss them more. And me info in it, cause me know I'm be alone. It's a different kind of image, me never really fall. Swerve and a dip, curl, turn your body. Me never hurt nobody, and girl, personally, yeah, I be curve and assist. Pan the fish, me play 6, come tear some of this.